Let's jump right into this explainer. Today, we're taking a completely objective look at Bell Financial Group's early 2026 ASX earnings. A really strong start to the year can completely set the tone for a company's trajectory. So we're going to dive straight into the numbers, figure out what's actually driving their growth right now, and see exactly how management is steering the ship.
Okay, the absolute standout figure from the first 4 months of 2026, it's a massive 197% increase in net profit after tax. We're talking $16.3 million compared to the same time last year. A near 200% jump is the kind of metric that literally forces you to stop and pay attention. It tells us something fundamental has shifted in their operational output over the last 12 months. But look, profit doesn't just happen in a vacuum, right? So let's check out the top line to see what's actually feeding this bottom line explosion.
So this profit surge was fueled by an overall unaudited revenue of $109.6 million. That is a very solid 37% increase across the board. Just think about the mechanics of that for a second. Revenue grew by 37%, but profit grew by 197%. This is a textbook, beautiful example of operating leverage. Basically, because their core fixed costs are already covered, every extra dollar of revenue they bring in just drops so much faster straight to the bottom line. It's like flipping a switch.
Now, to put these massive numbers in their proper context, we actually need to look backwards for just a quick second. The company explicitly notes in their release that trading conditions were, well, honestly, quite challenging in the first half of 2025. It was a really tough environment. But conditions improved markedly in the second half of that year. So what we're seeing right now in these early 2026 numbers isn't some overnight miracle. Rather, it's the culmination of this momentum that started building late last year and has basically just accelerated into a remarkably strong opening third of the year.
Moving on to the division breakdown, let's look at markets versus platforms.
To really understand where this growth is coming from, we have to look under the hood at their two main operational engines. First up, the markets division saw a huge 62% jump, pulling in $73.5 million, which was heavily driven by very active trading and deal activity. Meanwhile, the platforms division grew at a much steadier, quieter pace of 9%, hitting $33.2 million. So you've got this one highly dynamic, fast-growing segment sitting right alongside a slower, but very continuously growing segment.
And that contrast gets even sharper when we zoom in on the net profit. Get this, the markets division's profit absolutely skyrocketed by 423%, landing at $7.4 million, mostly because of trading volatility. But hey, do not gloss over the platforms division. Even though it only delivered a reliable 15% increase in growth, it actually brought in the highest total profit of the two, at $8.9 million. So yeah, platforms might not have the explosive percentage growth of markets this quarter, but it is the larger, heavier anchor for actual, tangible profit dollars.
All right, let's pivot over to their strategy and future outlook.
Seeing that kind of dynamic naturally makes you wonder, where is leadership actually steering this ship? Well, Co-Chief Executive Officer Dean Davenport made it clear that their overarching goal is to scale and diversify their revenue streams. And the why here is obvious. The business needs to perform consistently across all kinds of weird market cycles. Remember that explosive 423% growth in the markets division we just talked about? That is fantastic when trading is hot, but man, it leaves a company so vulnerable if deal flow dries up. To counter that, they're actively driving a transformation to become a broader, much more holistic wealth manager.
And Davenport's quote here really hits the nail on the head regarding their pivot. He says, "We expect this will result in an increasing contribution from fee-based revenue versus transaction-based revenue over time." Think about it. Transaction-based revenue is what drove the markets division. It's high-octane, super flashy, but totally unpredictable. Fee-based revenue, on the other hand, aligns right with their platforms division. It's recurring, it's sticky, and it provides this reliable floor for the company's earnings, regardless of whether the broader stock market is booming or busting. They are very purposefully trying to smooth out that earnings profile.
Just a quick note for full transparency here, the statutory revenue we've been talking about was adjusted to what management calls a management basis. Basically, they just stripped out the internal bookkeeping noise, stuff like internal product fees moving between their own divisions. Doing that lets us see the true external cash-generating power and health of the business. It gives us what management views as a much more accurate reflection of their true underlying operating performance.
Now, before we wrap things up today, I really need to mention that this explainer is strictly for informational and educational purposes only. We are just here to break down the structure and the strategies shown in the data. This absolutely does not constitute investment advice, and it is in no way a recommendation to buy or sell securities. Always do your own research or talk to a licensed professional before making any financial decisions. So, bringing it all together, the absolutely crucial takeaway today is this highly intentional transition toward fee-based wealth management, especially on the back of such an incredibly strong start to the year. So what do you think? Will this strategy to lean heavily into fee-based revenue actually secure their long-term stability and insulate them from future market volatility? Or do you think the temptation of those high-margin transaction deals is going to keep the markets division in the driver's seat? I'd love to hear your take, so share your thoughts and analysis in the comments down below. Thanks so much for joining me for this explainer, and I will see you in the next one.